Hey, what's up, studs? How you doing? Kunal here, Bulls on Wall Street. Guys, I want to talk to you a little bit about something that I think is really important part of trading, where the retail trader gets totally messed up. And I didn't even realize this till a handful of years ago. When I was new, I was under the assumption that you buy a stock that you like, you hold it, and essentially when it goes up, you make money. And then the 2001, 2000 recession hit, and all these stocks were tanking. And, I'm still trying to long all these technology stocks, and I was just losing my shirt. And what happened was, when I studied exactly what happened, it was like this thing that hit me in the head. I'm like, wow, like if I had just bet on these stocks to go down, I could have made money. And then the recession would have been something that would have been profitable for me. That tech bubble would have been a tech boom for me. And what I ended up doing was spending some time researching the other side of trading, which is to bet on stocks as they go down. And so short selling, guys, is something that even retail traders can do. With a margin account and $2,000, you can actually bet on stocks to go down. So when 2008 came and that recession came, and it was one of the deadliest, rowdiest stock markets that I've ever seen, I had only one thing to do, which was trade with the trend. So I was shorting bank stocks, commodity stocks, anything that I thought was the bubble trying to burst. And now I'm doing these short selling techniques and I'm profiting. So even as the market's crashing and people's retirements are going down, all of those type of things, I'm able to protect my retirement accounts by taking inverse ETFs, which is shorting the market or a particular index. And then in my day trading accounts, just hammering those banks, hammering the real estate stocks, all the way basically down to zero and profiting from it. So that 2008 market ended up being really one of my most profitable years as a trader, and definitely the most fun. And that's the thing that separates, right, the pros from really the retail traders. As retail traders, we're always just conditioned to think one way, and then the market just drops and you're left holding the bag. Your retirement accounts, your long-term accounts, and your day trading accounts get smoked out. But there's that whole other side to trend trading, in that markets go up and markets can come down. And there are two sides of every trade. And so we want to always sharpen this toolbox, because you never know when that moment comes where you need to short sell stocks and profit on them to go down. And then guess what? Even in bull markets, we still incorporate short selling techniques. I short stocks every single day when I see stocks that are either really overextended, or I see stocks that have very specific patterns that tell me that a reversal may be happening, and I can use that to time with the markets when the market's about to pull back, or just playing those parabolics. So guys, I'm going to have some tips here on how to get started in short selling. And as you guys have probably seen, I made a million videos on YouTube on some of the different patterns that I use for my short selling. Let me know what you think. Take care. Hey guys and girls, here are some short selling tips on how to get started in short selling stocks. Remember guys, we need to, as traders, learn to trade both ways. Markets go up and they come down. Stocks go up and they can come down. And if we're just focused on longing stocks, we're missing out on a whole nother world that is open to you for profit. So why short sell? Most traders are long biased, meaning they only trade stocks they expect to go up. Short selling doubles the number of trading opportunities, gives you more opportunities in bearish markets rather than trying to just buy stocks that are cheap and cheap and cheap. You now have a way to capitalize on it while the stocks are going down. Guys, one of the biggest causes of losses for me as a new trader was when a stock, especially a well-known stock like whatever, Microsoft, Apple, Lululemon, whatever, like a name brand stock, it would get really cheap and it'd get down into like the single digits. I would sit there and go, oh my gosh. I would watch it, it'd be at 80, then 70, then 60, 50. I'd be watching and then finally get to like 20 or 10 and my cheap dar would come on and I'd be like, wow, this is cheap. I've got to get it. And then you know what would happen? I'm going against a trend. I don't have a particular catalyst yet to actually start the reversal. And so that cheap gets cheaper. Your $10 stock goes to 8, then it goes to 7, then it goes to 6. And sure, at some point they can reverse, but at what point? At what point do we tax not just all our financial capital, but more importantly in trading, the most important capital is your mental capital. Watching your stock just go down and down and down is taxing on the mind also, and it stretches your finances. But there's that whole other way that if I had known that I could be shorting these things, then I didn't have to just sit there and try to bottom fish these things, trying to guess when cheap is actually cheap, right? I can be riding the trend down, and then when the reversal actually starts, now I can go long the stock and profit on it in both ways. Short selling also increases your understanding of the market, as now you look at every chart from the perspective of a potential long or short trader. See, we have biases. Sometimes when we want to see something in a chart, when we want to see a pattern, we can put a pattern on anything. If you really think about what a chart is, right, it's just a jumble of lines. If you want to find a flag on a stock, trust me, you can rationalize and force a flag onto the stock. When you start to learn the different patterns on not just longs but shorts, now you are looking at a stock in a 360-degree angle, but no longer are you forcing your long bias on the stock, looking for that specific thing. You're just looking for ways to profit, whether it is long or short, and that can really help your results. It also helps you become aware of short squeezes, in which a stock surges up unexpectedly. Short squeezes can occur when there are a large number of traders who have shorted a particular stock. Guys, some of my best long trades have been stocks with really strong breakout charts that get hit with some type of news, and it looks like it's gone up a lot, and all the short sellers just pile into this thing with a very particular bias that this stock's up too much, and you set off really sometimes the mother of all short squeezes on these things. And you can get really parabolic on these things when you couple in news, float, and a bunch of short sellers coming in at the wrong time. That can set off a short squeeze. And one of the things I always teach in my boot camp is how to find inflection points in stocks. How to find inflection points in stocks where you may lure in the short sellers because it looks like a really obvious level, and then price gets absorbed there, and boom, you break out, and now you have double the buying that comes into the stock. You got the breakout buyers, but you also get the short sellers who have to buy to cover to get out of their stock. So what is short selling? When you short a stock, you first borrow the shares from your broker, and you immediately sell them. So how you want to look at this is it's essentially when you're buying a stock and you sell it, right? You buy first and you sell second. Short selling is just in reverse. You are selling short first, and then you are buying to cover. And so you're just doing the opposite of what a long trade would be. Closing a short is called covering. It involves buying those shares back and returning them to your broker. So you buy to cover a stock. And that's how some of those short squeezes can be so powerful, because to get out of your short, you have to buy back those stocks. So if the stock has decreased in price from when you shorted it, it'll cost less to buy the shares back than what you sold them for, and you pocket the difference. So if you short something, meaning you sell short at $20 and it gets down to $19, you are going to buy those shares back at 19, so you got them cheaper. So you're going to profit that dollar. If the stock increased in price, it's going to cost more to buy back those shares than what you originally sold it for. The difference is your loss. How do you short a stock? There are a few different requirements for shorting stocks. Number one is a margin account. When you sell a stock, it can often take up to 3 days for it to clear in your account. During that time, your capital is tied up. It's just called a settlement. With a margin account, the broker allows you to trade as if the capital was available again immediately. A margin account is required for short selling, as well as in day trading in general. Then you got to have shares available to short. If your broker doesn't have shares available to borrow, you can't short the stock. Some brokers have an extensive list of stocks available to borrow, while others are limited. So guys, if you're trading in Ameritrade or E-Trade and you want to short Apple Computers or Ford Motor Company or General Motors, well, those are easy to borrow stocks, right? They're well-known companies, huge multi-billion-dollar companies that have been around for dozens of years. Pretty much any broker you go to, they're going to let you short that stock. Now, if you're looking at a specialty biotech stock, that's $2 or $3 and it's gone from, $2 to $20 in a couple days, well, that's a little bit different. Like, for example, a few days ago, we were shorting AKAO in our chat room. That was a stock that was just a couple bucks and ran all the way to $16 in 2 days. That stock, because it's a newer stock, it's not very well known, becomes harder to borrow. So if you are at a regular broker like an Ameritrade or a Schwab, you're probably not going to be able to get borrows on a stock like that, as they make it difficult to short those stocks at retail brokers. They deem it a little bit dangerous, but also there's not an infinite number of shares of any given stock available, right? If the float is low on a stock, which means basically the number of outstanding shares available, then the borrow list is going to be fairly limited. So only a handful of places will have them. For me and my students, we have special arrangements made so that we can always get those borrows, and if they're not available, we can request them. So always good when you're short selling. If you're looking to short those specialty stocks that are $1, $2, $3, that type of deal, then make sure you have a couple of different brokerages so that you can always find those shares available. And if you guys are having trouble with some of that, feel free to contact me. I can get you some information on some different places that have really good borrows. Alternative uptick rule. This SEC rule prohibits traders from shorting a stock that's already dropped more than 10% in one trading day. The purpose is to stop flash crashes from occurring. So this is a really important rule. When a stock is down more than 10% and you see it at a breakdown level, oftentimes those are levels that are just too obvious to short. And since you can't short on the bid, and you can't really short it at lows, what often happens at those levels, they squeeze up. And so when you see the uptick rule on a stock, always short into spikes. I like to short into EMAs or short into resistance spots, do double tops or some other type of pattern when I know that an uptick rule is on a stock. So how do you manage the risk? Obviously, this is the most important part of everything we do. Guys, our job and our number one job as traders is to be risk managers. A professional trader, all he really is a professional risk manager. He's always thinking about how to limit his risk, how to limit the risk, how to offshore the risk a little bit on every single one of his trades. So risk management on a short trade is very similar to risk management on a long trade. Number one, you want to have clearly defined stop losses that you establish before entering the trade. Anytime I get into a trade, guys, I know already the maximum I can lose on that trade. On a psychological level, I think that's really important. Where you see traders make a lot of mental mistakes is through uncertainty. They don't know if their stock's going to go up or down. They don't know how much they can lose. Their awareness of what could happen in that stock is jumbled. And so it makes them nervous, and it makes them prone to emotional errors, getting out too early, selling it too soon and leaving money on the table, or holding it too long and taking a big loss. When we take trades, I already have an established amount that I can lose on the trade. I'm going to lose $200 on this trade. I can lose $400 on this trade. And so mentally, I'm prepared. And I've already said to myself, I count that $400 gone. If that's my risk on it, I already count it gone. And so if I make money, it becomes like a gift. But I know right off the bat, this is my max pain. And so I'm fully aware to handle the ups and downs and the gyrations that may come into the stock because the level of uncertainty has been reduced. 2, targeted levels for scaling out. Right? Always trade your plan. When you come into a stock, right, beyond just having a pattern and a specific area that you'd like to enter, you've got to have some ideas on where you want to get out of that stock. You know, there's a whole different number of reasons you may get out of a stock. You know, it could be from your targets getting hit. Maybe the stock gets too extended, it gets overbought. You know, I like to use a dynamic risk system so that I can have targeted levels for scaling out, but then also keep a few shares for the lotto, the home run, right? Where I put a stop in my short price and I let the stock develop and go where it's got to go. But I've already scaled out a few and taken some profits. 3, a position size that doesn't place excessive risk on your overall account size, but is large enough for you to profit after commissions and slippage. There's a sweet spot in there, guys. When you're new, there's 2 types of trader. There's the cowboy trader who's all in on every single trade. And he gets lucky a couple times, builds up his account, but then at some point he loses it. You know, that happens to almost everybody at some point. Then you have the other type of person, the analytical, risk-averse trader who has everything calculated out. I can lose $40 on this trade and $20 on this trade. And if I have $20 of risk on the next 50 trades, I could lose them and I'd still have only 1/3 of my account gone, right? But that type of trader, they can never make profits because after commissions, taxes, slippage, their gains are just too small, and then their losses end up being the same size as their gains, and they just bleed themselves out. They end up taking hundreds of trades with very low risk, but also very low reward, and then the commissions eat up your account. You know, in my chat room right now, I'm trading a small account that my students at the Click Fund get to trade. You know, we give our students $2,000 accounts, no pattern day trade rule. We give them $15,000 in buying power, 27 cents per 100 shares commission, and you know, I'm showing them how to trade. And there are times where sure we have to be in just 50 shares or 100 shares on a stock, but there are other times where we have to step it up when we see unique opportunities where the reward is good and the risk is still at $50 or $100. That's how you start to grow a small account, and that's what I'm showing them every day on screen sharing video on how to do. How to take that couple $1,000 and turn it into something bigger, because it's only when you get 10,000, 20,000, you know, and you grow your account to those levels, you can make some serious moves. You've got to, though, start somewhere. We all start at the bottom. And then you got to slowly grow this thing up, couple $100 a day, couple $100 at a time, till you get to that point. But there's a sweet spot in your position sizing where that you have to always find, where you're not risking too much, but you do have enough risk on the table so that when you have a great reward to risk opportunity, because remember, that's why it's called opportunity, you're able to go in with a good size and take that big chunk, those account builder type trades. Those are very, very important when you're trading a small account. I look at all the trades I do. Is this an income trade? Am I going to make $100 on it? or is an account builder trade? Do I have the opportunity $400, $500, $600 on it? Because those are the ones when you can catch them, you can really build up your account. And that doesn't mean you take $600 risk. Most of the time when I have those kind of account builder trades, it's still at $100 risk, but the trade starts to develop into something unique because in the beginning I had a good reward to risk opportunity and a nice pattern. And then sometimes you just get a little bit lucky because you plan to be in those type of situations. One additional consideration for short trade is that your losses are theoretically limitless. If you short a stock at 10 and it jumps to 100, you're going to lose 10 times as much money as you originally invested. So an initial position of $5,000 would lead to a $50,000 loss. In a long position, at the most, your $5,000 buy just can go to zero. So your max loss would be $5,000. Now, that's a theoretical situation. Remember, we use stop losses. So if I short a stock at 10, I'm going to be putting my stop loss at $10.20 or $10.50, wherever the chart dictates. So, I'm not letting it go to $100. So those are theoretical things where, yeah, if you hold your short position forever, then you could infinitely, lose. But your broker typically will only let you hold a short for a few days anyways. But also, at some point, if you have $5,000, your broker's not going to let you lose $50,000, right? When you hit 5, they usually will X you out of the trade. So just a couple things to think about. Theoretically, yes, you can lose a lot more than you put in, but you can do the same thing with a long. Are there any good short selling strategies? One of my favorite short selling strategies is the opening range breakout, where a momentum stock gaps down on the open and then forms a consolidation range. This can be a bear flag or some type of consolidation pattern where you can short it on the break of range. I made a couple trade review videos that you guys can look at into this, and I do this type of trade all the time. One of the trades that I just recently took was a trade in this Agio. This is the kind of opening range type of play that I typically like to do, where you get stocks that gap down on some type of earnings, and then you make an intraday bear flag, and then you short that first bear flag. So you can see here what happened was, you get this Agio, and it comes down and gaps down at the open. Then at the open, you make an opening range pattern, which is usually 3 candles, 3 to 10 candles. And when you break down that opening range, you can take the short position with a stop above, and you can ride this down for the morning or the afternoon. This is a really quick pattern. It's meant for a day trade type pattern, but I use this type of pattern all the time. Another one that we took just a handful of days ago was a very, very similar pattern, and it was on a stock called ALXN. So ALXN was a stock that had earnings out. And guys, this was a huge day. This was one of my account builder days. I had 100 shares short of this, and I basically made almost $1,000 on it with the same type of setup. The stock gapped down at the open, and then you could see this consolidation range at the open. And so when it took down its opening range, I shorted 100 shares. So you short 100 shares at $118. My stop was at about $119 above the VWAP, so I was risking about $100. And then it was just a matter of rip and ride, slip and slide. As this thing thrusts down, cover half your position. And then when you see different patterns, such as a bear flag right here, you can add more shares and play the rip down. So overall, I made almost $1,000 on this trade, trading about 100 shares, give or take, 80 shares, 75 shares, and I, mix and matching in here. But we got a really nice run. I ended up covering up all my shares, my last bit of shares at about 111. Ends up being a good trade. One of the misnomers for new traders is they think they can only trade penny stocks when they have a small account. But if you have a stock that going to have a really big range, say $5, $10, even if you have 50 shares of it, you can make really good moves, and it doesn't have to be like, oh, I have a $1 stock, and I'm going to be able to have 1,000 shares of it, right? In some of the higher price stocks, you can get more range. And so, I had students that were playing, 50 shares of this thing, and they made hundreds of dollars trading it using a really small amount of shares because of the range on the stock. And so, be mindful of that. It's always, we just bash it in our heads. We just think that, cheap is good when trading stocks. It allows you to have more shares. But more shares means higher commission prices, and it also means it's harder to get in and out, right? Because you have all these shares you have to dump for liquidity purposes. When I trade 50 shares of a stock like this in my small accounts program, that 50 shares is going to cost me 13 cents in commissions. 13 cents versus, right, 1,000 shares of something's going to cost you $4 or $5. And it doesn't seem like a lot. But when you're talking about a small account, that is a huge deal because those $5 trades, they add up. $5, $5, $5, $5, right? You take 5 or 6, you just spent $50. My commissions last week were like $27 and change, and I made, over a dozen trades. I made 3, 4 trades every day, in and out. So just something to be mindful of. It doesn't mean you have to trade $100 stocks like I do, and I do trade $1 stocks, but there's a whole different way of looking at things. When you get stocks with range, all your patterns, like your bear flags and your short patterns that you're seeing, they tend to work a little bit cleaner. They're easier to spot because you have bigger range. Sometimes when your range is really tight, it's hard to see the patterns. And so just something to keep an eye on as you're training your eyes to see what a professional trader sees. So guys, I hope you guys enjoyed this video. Feel free to let me know any questions. I have a couple other trade review videos, and I'll link them into the YouTube so that you guys can watch them, but they're on our YouTube channel and stuff like that also. But I'll link them right into it, and you guys will have a good time. Let me know if you have any questions, guys. As you know, I'm an open book. If you want to just kind of make fun of me and tell me that I'm bald or stupid, I can do that. If you want to say I'm cool, I can do that. And if you just want to contribute and ask some positive questions, I love talking about stocks. This is what I do. So let's do that. Leave me any comments, or you can feel free to email me anytime, canal@bullsonwallstreet.com. I take questions all day. That's what I do. I'm a teacher at heart. So let me know what you guys think. Take care, guys.